Okay, so today, let me first go over the schedule again real quick. All right, so today the chapter 2 homework is due. We're gonna go over that. And I'm gonna pull up the solutions and share with you. So on this homework, I'm really not that concerned that you have the exact answers that I came up with, because some of the stuff was a bit confusing. But you were supposed to create a balance sheet and an income statement and then calculate those ratios and just analyze your situation. So the main takeaway from this homework is to be able to calculate those ratios and interpret the ratios and then just kind of analyze the situation. So for example, like when you calculated the monthly payment ratio, what is that called? The debt service ratio with the monthly payments. It was a little confusing as to what you were supposed to include for monthly payments. So we'll go over that. But anyway, just to repeat, I'm not going to knock you off points if you don't have the exact numbers that I have come up with. So we'll go over that in a minute. So that was due today. And then on Wednesday, the chapter 3 homework is due on Wednesday. I'm going to pull up chapter 3. I wanted to mention a few things about chapter 3, and then we're going to move on to chapter 4. So we're kind of easing, like I mentioned last week, we're kind of easing back into the swing of things, and so the pace is a little bit slow right now. We'll pick up later. So we just have to cover chapters 4 and 5, and then looking forward, the first exam is going to be on Monday, October 11th. So that's still a little ways off. All right, did anybody happen to bring in a current event today? Okay, we need to get back on track with that. So now that you're all here, would anybody like to bring in a current event for Wednesday? Can you want to talk about it today?
Dad wrote that like weeks ago.
Okay.
So that'd be a no.
Okay, Brad, to do it on Wednesday then. Okay. Anybody else? Is that share? Do it on for Wednesday. Okay, well, try to. It doesn't have to be like in finalized form. If you just want to prepare to talk about, then you can turn to the next one. So, okay. So let me pull up the chapter 2.
We have to write 2 of them.
Yeah, you have to write 2 of them. So we're going to get backed up at the end of the semester if we don't start getting on track with this. Okay, let me pull up the chapter 2 homework then. Okay, so who would like to summarize what's going on with these people with the Beckers? Who would like to just summarize their situation? Do they both work?
Oh, yeah.
Okay. And what's going on in their lives? Yeah, so they just found out that they're pregnant, and she let's see what their salary is here. Huh? Oh, the name's probably different on, I don't have the web version. Are these numbers the same?
Yeah.
Okay.
Yeah.
And for those of you who had the web version, could you not access the worksheets?
No.
Okay.
You have to go on Cengage, and there's a couple of folders you have to go to, and then you can download every worksheet from the folder.
Oh, okay.
How to do it, but I figured it out.
Okay, so you don't have to use the worksheets, but I know
I
that,
just like made it for one word as the worksheet.
that's fine,
Like it looks like it.
right? So anyway, here's their their gross salary and take home salary. So he makes 76 gross, she makes 42 gross. So she wants to she's gonna have to take off work when she has a baby. She's freaking out about that. And he's saying, it's no big deal. Don't worry about it. We'll work it out. So she's kind of stressed out about that. So reading this whole case kind of reminded me when I worked as a financial planner, and the money issues, finances are way up there with the top reasons. That's like 1 and 2 of marital issues and relationship issues and the top reasons for divorce. So especially, I mean, this isn't really applicable for you guys, but because as you get older and maybe you have, people are more established when they get older. So if you get into a relationship when you get older, then it can be even more complicated. And so the point that I'm making here is it's important to talk to your future spouse or your significant other early on about money. It's a good idea to just get an idea of what's their money personality like versus your money personality like. And then talk about, are you going to keep your money separate? Are you going to commingle your money? Because all these things, things that don't really seem to be that big of a deal when you're dating can become a really big deal once you have to deal with all these issues. So anyway, finances are a big issue for a lot of people. And so it's just important to keep the lines of communication open and so forth. All right, so anyway, so they're examining their financial condition in order to see what they can do. So here's all this information here. And then you were supposed to, you needed to prepare a balance sheet and an income statement. So this is what your balance sheet should have looked like. The cash on hand was $85. They have $485 in their checking account. Money market funds is, and we're going to go over chapter 4 today. So we're going to learn more about these specific accounts. The money market account, $2,500. So their total liquid assets should have gotten $3,070. They have $7,500 in stocks. They don't have anything else here. So their investments, $7,500. Their primary residence is worth $185,000. And then this is their personal property. They just have cars and some household furnishings. So their total assets, you should have gotten $210,570. Okay, so
whenever you do this, do you have to write out every single thing, even if it's $0?
no, you don't have to. And it would, so if you saw, hopefully you remembered my old email from before the storm. I told you what the current liabilities were, because it's kind of hard to figure out what's a current liability and what's an expense. So these are the only current liabilities. Their credit card balances, their bank credit card balances, and their travel and entertainment credit card balances. So again, if you didn't get this right, it's not a big deal, but those are the only total current liabilities. Then they have their mortgage, the balance on their mortgage, and the balance on their car. Everything else is going to be expenses in the income statement. So here's their long-term liabilities. Here's their total. So you add these two up, you get their total liabilities. And so then you subtract the total liabilities from the total assets, and then that's their net worth. And so they're worth $55,000. So this is really I would say this is a typical of somebody in their late 20s and 30s, because you're just starting out. You haven't had time to accumulate a lot of cash. And I mean, even if you have a negative net worth starting out, as I was mentioning, it's not a big deal, because if you have student loans and so forth, a lot of people might even have a negative net worth initially. But when you're younger, having a really low net worth is reasonable. Okay, so that's what the balance sheet should look like. So you could have done it. You didn't have to include all these things with zeros, but that's what it should have looked like, whether you did it in Excel or Word or using the worksheet. Any questions?
What about the deposit and the money market account and the extra stock loan? Who would include that?
They didn't include that because
And I added it in.
You added that in. Um, Yeah, I mean, again, they're not clear. I promise, you could add that in, it's fine, because they're not really, they're thinking of the snapshot in time before they purchased it. But if you added it in, that's fine. Okay, here's their income statement. So here's their gross income here, their salary and their wages. So their total income is you just added up their gross salary and wages. And then here's their expenses. So here's their mortgage payment. And I think that includes property taxes. Yeah, it does. So that's their mortgage payment. Here's their utilities, groceries, their loan, their auto loan payment, maintenance on their car, doctor, clothes, homeowners insurance, auto insurance, taxes. This is income and social security that's mentioned in the case. And then they spend $5,000 on vacations and other recreational entertainment is $4,000. And I don't know why this won't come up on the sheet, but it's that's the last. Let's see what happened here. This got cut off. So anyway, I don't know why that's cut off, but below that, you should have credit card payments, purchase of common stock, and then additions to a money market account. So that it is, did you include it as an expense, Wendy? Okay, so below this $4,000, you should have, just to repeat, credit card payments of $2,210, purchase of common stock of $7,500, and then the additions to the money market of $500. So the total expenses should have been $86,739. Total income is $118. So the difference is called the cash surplus in financial planning. So their cash surplus is $31,261. Okay, so that's any questions on the income statement? All right, so let's go through these questions then. Okay, so the solvency ratio. So what is their solvency ratio? Brianna, what'd you get for that?
I got 26.24.
Yeah, 26.24. So the solvency ratio is right here. Okay, so the solvency ratio is the total net worth from the balance sheet divided by the total assets. So it's 26%. So that means that their assets could decline by 26% before they would have a negative net worth, before they would be insolvent. So think about their house. So just think about the housing market. Let's say they bought it during a bubble. If their house decreases by 26%, then they would be considered insolvent. Or if they've got some, well, they just bought some stocks, they didn't have any at the time. But if their investments or any of their assets, if their assets in total decrease by 26%, they would be considered to be insolvent. So I don't think this is really on the low side for a couple in their 20s and 30s, but I guess the overall it would be considered to be on the low side. So it just means, so the solvency ratio, to repeat that, just means that's your cushion. That's how much your assets, the percentage your assets could decrease before you're considered insolvent. Okay, then the liquidity ratio, how many times over can they pay their current debts? So how much in current assets do they have to be able to pay off their current debts or their debts for the year? So it's their liquid assets divided by their total current debts. So that's 1.15. So they've, but really one or higher is better. It means you've got enough money to pay off your debts. Okay, and then the cash savings ratio, that's the cash surplus, which is right here, the total income minus the expenses, divided by their after-tax income. So you had to take their gross income and just use their net income. And so that's 38%. So that's their savings ratio is really pretty good. That's here's the average for the US, 8%. So they've got a 38% savings ratio. So maybe that's why the husband isn't that concerned about having the baby and his wife having to take off, because he realizes they do have a lot of savings. Yes.
So whenever you're doing the income after taxes, do you consider Social Security as tax?
Yes. Yes. Because that's taken out.
I don't want to get a.
See, I didn't check that number. They should have, I would think you would just add up the two net incomes. I didn't check that number actually. The easiest thing to do if they didn't do that is just to add their take home pay. So 52.5 plus 29.2 is 81.7. Yeah. So you just have to come back up here and just add up the take home pay.
Oh,
Okay.
I did like their total income subtracted by a federal, state, and Social Security.
No, because they could have, you could have other things coming out.
Okay.
Like, for example, I belong to the rec center, so they take out $25 a month. So I would just use my take home pay.
Okay.
You see what I'm saying? Even though that's technically not, taxes. So anyway, you just use the take home pay. Okay, so they have a good savings ratio. Okay, and then the debt service ratio. Okay, the way they got these monthly loan payments is they used so it's the mortgage payment plus the auto loan plus the credit card loan payments. Okay, so on the first page, you're going to see on the first page, they have travel and entertainment card balances. That's not being included, and these credit card bank balances aren't being included. They're just including the things that specifically say loans. So anyway, the way you're getting that, the way you get that number is the mortgage payment. This is monthly, of course. The mortgage payment per month is $919, and then the credit card loan payment is $184, and then the auto loan is $179, and so that comes up to the $1,282. Right. So anyway, that's how we got to the $1,282. Again, if you didn't get that, don't worry about it. But you just need to know how to calculate the debt service ratio and really be able to explain it. So basically, what is this saying? What is this 13 in plain English? What does that 13% mean?
Income from one that there's the month.
Right. So now this is their gross monthly income. This is not so. To me, if I was going to calculate this on my own, from my own perspective, I wouldn't be using my net. I would use my take home. But when you apply for a loan, when they calculate this, they're asking you what your gross monthly income is. So anyway, so this is saying that 13% of their gross monthly income is going towards debt. So that's pretty low. Really, they like you to be below a third. for a car loan, you could still get approved if you're like below, right around, you can go up as high as 50%. But that's pretty crazy to think about half of your money going towards loans. So anyway, this 13% is really good. They've got more than enough to cover their debts. Okay, so then they asked the question, what advice would you give these people? Would you side more with the wife, side more with the husband? Are they in good shape financially? Should they be concerned about having a baby? You should always be concerned about having a baby, okay. Yeah, they don't really have a lot of wiggle room because, I mean, she's making what is it, 42,000? That's substantial if she wants to take it. I think it said she wanted to take a year off. So.
And it essentially just wanted to quit her job. It didn't say when she was on.
Yeah, yeah, exactly, right. She wants to quit her job. So that could be a problem. But they do spend, I mean, if you could go through this, she makes 42,000 a year. She grosses 29. Okay, so her take home pay is 29,000. So if you start with just that, if they, they have, where was their cash surplus? So if her take home pay is 29,000, their cash surplus is 31,000. And so they could still cash flow if she quit her job. And then in addition to this, they are, they have 5,000 for her vacations or something. So they could cut some, they could definitely tighten their belt, and with that cash surplus, I think they could get by if she quit her job, but it would be tight. Okay, that's any questions on this one? Okay, let's go on to the second one then. So this person is trying to budget. Okay, so this girl recently graduated from college. She moved to Atlanta to take a job. She is she's making $45,000. She has bank cards, and her take home, let's see. Okay, so here's a summary of her expenses. All right, and then this is just additional information. So you had to prepare a cash budget. So again, I'm not looking for all the exact answers that we have here, but this is a sample of what your budget should have looked like. And so we see here that she has a deficit. The first year, she's got a deficit of $1,263. And then the next year she has a surplus of $1,344. Then they ask you to, they put in some expense, some inflation and expense estimates here of things increasing. And you're supposed to, then you had to prepare this month by month budget, this worksheet. Okay, but what I'm really interested in this problem is the analysis. So what advice would you give her?
She had a few months when there was like a large deficit. So I recommended that she start out similar to bigger payment. But for insurance, she was paying twice a year. Pay that once a year versus
Monthly.
Monthly versus
Okay.
twice a year.
Okay.
That she had a lot of spending for like unnecessary items like eating out, clothing, entertainment.
Yeah, that's a good point. So that's a really good point about, changing her.
I recommended if she wanted to take a vacation, because she was gonna spend like 2,100 on vacations.
Right.
Either not go on vacation or she had to sacrifice and cut all those categories down.
Yeah, because she's got, right, exactly. I mean, does she really, 2,100 on a vacation? I mean, honestly, you can
that could be done cheaper or don't go, because then she's got almost 3,000 here in recreation and entertainment. And then to me, this was the biggest red flag up here. Her dining out is as much as her groceries. So you could definitely cut out on the dining out. So she does have a lot of extra stuff in here that's not necessary, for sure. And then the clothing too, that seemed high. Where is that? Clothes, shoes, and accessories. You know, that's, what is 2250? That's $187.50 a month on clothing and accessories. That's not necessary either. So there's a lot of room to cut back here. Okay, so anyway, that's just what I was looking for, really, was mainly your analysis of her situation.
First savings ratio, did you get 2.81?
Did they ask for that?
I must have just did it just to compare things and make the recommendations.
Okay,
Because that's how I kind of determined how much she would need to save.
well, the
That's
savings
what
ratio,
it
it's, okay, would have been at the 1341 divided by the 38.4, right?
What did you get for the cash report?
Right here, 1341.
I was young, but
Okay,
it's still in the thousands.
yeah, her saving, yeah, she's, this is all screwed up. I mean, she's a mess because she doesn't have a realistic budget, basically, is what the problem is. So she's, but being single, she's probably figuring she's gonna spend all this money. And she's just not being realistic about it. Okay, anyway, any other questions? Okay, let's move on to chapter 4 then. Oh, wait, I did want to mention a couple other things from chapter 3 because we ran out of time. So just a second. Okay, I think this is kind of where we stopped. So we talked about the credits. Okay, let's talk about the credits versus the deductions again. So if you, with a tax deduction, you've already paid that money. And so it's the deduction, it's not a dollar for dollar situation. The deduction is the value of the deduction times the tax rate. So let's say you spent $1,000. Let's say you put $1,000 into your IRA and into a traditional IRA, and you're in the 20% tax bracket. You're only going to get a 20% tax deduction, a $200 tax deduction. You spend if you contributed $1,000 to an IRA, you're in the 20% tax bracket. Your deduction is not going to be $1,000. It's going to be you're deducting the whole $1,000, but your tax savings is only going to be $200. So you're really spending $800 to get a $200 savings you see on your taxes. A credit is dollar for dollar. So for example, after Katrina, they decided that, this is, since I remember Katrina, I know a lot of you are too young to remember Katrina, but I'm comparing Katrina to Ida.
they're not doing, the federal government is not doing the same things. They're not giving us as much benefits as they. So like, for example, with Katrina, what they did was all these people who didn't have insurance, a lot of people in New Orleans did not have flood insurance. And so they said, well, if you don't have flood insurance, we're gonna do this thing called the road home policy. And the road home program, not policy, the road home program is a federal program, whereas you could opt to rebuild your house, you could opt to move, to sell, to leave your house and stay in the state, or you could just leave your house and go somewhere else. They were giving people up to like $140,000 on the road home. So in other words, if you just didn't pay for insurance for all these years and didn't have flood insurance, the road home program was making you whole again, was giving you money. Well, there was a big outcry because a lot of people said, well, wait a second, I've been paying insurance all these years, and now all these people who didn't pay insurance are getting this money. And so that was one issue. And then another issue is they have, this is what I'm getting at, that was kind of an offshoot. But here was another thing that happened. In Florida and in Louisiana, they have citizens insurance. So they have state mandated insurance. And so what they did after Katrina is on everyone's insurance policies, if you have private insurance, they're making you pay a portion for the citizens. So in other words, like when I get my homeowner's insurance, I have a bill of like $183 for citizens. And it's basically to subsidize the state insurance. And so there was a big outcry for that because of that too. So Governor Blanco said, I want to refund everybody. It's not fair if you have private insurance that you're also paying the subsidy for citizens. And so they gave everyone a credit. So when you do your state taxes, this has been going on since Katrina. When you do your state income taxes, you can get a credit back of whatever you paid for. It'll say citizens, or there's another thing called coastal. So for example, like when I do my state taxes, let's say I owe $200 on my state taxes, and my refund and I paid the citizens thing, my surcharge was like $200. Theoretically, I get that credit and I don't pay anything in tax. So if I was getting money back and I was getting that credit, I get that much more back. So a credit is money that they're actually giving to you dollar for dollar. So a credit is always better than a deduction on your taxes.
Okay, so that's the difference between credits and deductions. Now, the tax withholding, it's a pay-as-you-go system. This is another thing you want to make sure when you get out in the real world and have a job or a full-time job. I know a lot of you are working now, but we have a full-time job, or if you're in business for yourself, or if you maybe have some capital gains that you've taken, you don't want to get caught at the end of the year owing all this money to the IRS. The IRS doesn't care if we pay them money and they keep it all year and give us a big refund. But if you owe more than a certain amount, and I think it might be around $1,000, but it's between $1,000 and $2,000, they will levy they'll charge you a penalty. So they don't want you to have to pay, they don't want you to wait and pay it all at once. They want that money throughout the year. So once you do your taxes, if you got a big refund back, then you should go to your employer and say, hey, I'm going to reduce my withholding. If you owe money, if you owe quite a bit of money, then you might want to, you should probably increase your withholding, because it's not fun to have to pay a big tax bill anyway. So I try to even mine out to where I don't owe anything. I zero it out. So if you do owe a lot at the end of the year, they will assess you a penalty. So how do you get around that? Because not everybody has W-2 income where they can just have their employer withhold it. Well, if you have, let's say that you have a job, but you also have a lot of capital gains because you did real well in the stock market and you made some short-term sales. Well, then you can make quarterly payments. So let's say that you have, or if you have business income
you can make payments quarterly to the IRS to make sure that you don't have this penalty. Now, sometimes that's hard to do also. So like I've had relatives, I do taxes for a lot of my friends and relatives. And at the end of the year, if it looks like they're gonna maybe owe a lot because of gains or something, I'll just have them make a quarterly payment at the end of the year. As long as you make that last quarterly payment, the IRS is fine with that. And then you won't have, because you don't want to pay them any more money than you have to. And you don't want to be assessed a penalty. So anyway, they're just explaining here that we have to pay our taxes throughout the year. And if you're not employed, or if you have a lot of capital gains, you can make quarterly payments, or at least just make those payments by the end of the year.
All right. Okay, so then the tax forms, they're just explaining the tax forms here. 1040 is the main form. And there's a lot of, oh, you can get an extension. So this is what a lot of people don't realize too. If you file for an extension, you still have to pay the taxes by April 15th. So filing for an extension doesn't give you more time to pay. You have to estimate how much would be due and make that payment to the IRS if you're going to file an extension. So anyway, the first extension is, well, it gives you what they didn't used to do this. You used to have to file 2 extensions to get to October 15th. But if you file this form, you automatically have an extension from April 15th to October 15th. And after IDA, I think they increased, I think the extension has now been extended to January 1st. I heard that a couple days after the storm. I'm not sure if that was signed into law or not, but I think there's even a longer extension now for people who are affected by this storm. So anyway, you can file an extension, but you still have to pay. And so the federal taxes are typically due April 15th. Louisiana state taxes are not due till May 15th, which is kind of interesting. You have another month to pay those. So this is what I typically try to do is normally I do owe for just the way it works out with my withholding. And I always owe a little bit for the feds, but then I'm getting a refund from the state. So I try to file early and then get my state refund before I have to pay for the feds. But anyway, that's how that works. So audit, IRS audit. Have any of you ever known someone who's been audited by the IRS? Okay, you want to share that experience?
My dad got audited, but I don't know actually what happened.
Okay, did it cause a lot of stress in your household for a while?
Yeah, I mean, I was younger, so I don't know much.
So, you know, back in the old days, you would actually file a paper return. And then when the software, when the software companies got around, and when they developed all the software that we could use like TurboTax and such, and you could file electronically, they would say file electronically, because when you file electronically, nobody actually sees your taxes. The taxes don't physically touch anybody's hands, and you're less likely to get audited. That was like the rumor. But now everyone files electronically. So I use TurboTax, and any of these software programs, they will tell you your likelihood of being audited. They will. So once you fill out your taxes, they look at all these averages, and if they see any red flags, they'll tell you, what's your chances of being audited and so forth. It's very rare that you would be audited. But if you can also, if you feel like you have kind of an unusual situation with your taxes and that you might be audited, you can pay extra with TurboTax, like another $50 for audit protection. And then if you're audited, they'll handle it for you. I've never had to thankfully go through that, but that kind of can give you some peace of mind. And just, I guess, it's important to save your receipts and just be able to document these document all that you put down in your tax return in case you're audited. So here's some red flags. I had a colleague of mine
not here at Nichols, but at another college. He moved up to, he was teaching up in Philadelphia for a while. He's from Bangladesh originally. He's not American, so he doesn't really know all the ins and outs of all of our bureaucracy. And he was using his office. He was using part of his home as an office, and he was deducting all these expenses, his electricity, his gas and all that. And he got audited. I don't know the outcome of it, but he was really stressed over it. But that's a red flag. If you're using these are people who are using their homes as offices, and then they're deducting like a fourth of all of their expenses, all their household expenses. Those kinds of things can cause red flags. So I have not done that. I've never done that because I've heard that that's an audit flag. Also, people who own their own business, if you have business income or self-employment income, you're more apt to be audited. So if you have business income or self-employment income, just make sure that you can document everything you are audited. So anyway, that it's not, the IRS, I think, has a reputation now of being a little bit nicer to deal with. And so it's not as much of a problem as it has been in the past if you do get audited. Now there's all these scams out there. And so the IRS, tell this to your grandparents or any older relatives that you have. Your parents probably know this. The IRS will never call you. So I've actually gotten phone calls from people saying they're the IRS. They will never call you. If you're going to be audited or anything, they're going to send it to you through the mail. And so you've probably all gotten a Social Security call. Now the IRS, someone's calling saying they're the IRS. Okay, anyway. And then sometimes I've actually made tax errors. They'll find errors and then they'll send you a notice saying that you owe more money or they owe you more money. So that can happen, but they always contact you through the mail. Okay, so you can use a tax preparer. There's H&R Block it has been around for years. Personally, I don't like to use a tax preparer because the 90% of the labor involved in doing your taxes is getting everything together. So why should I do all that and just give it to a preparer? I can do it myself. And they make it easy with the software programs that they have now. All right. Okay, income shifting. This is what we're talking about, like with a traditional IRA, where you get the deduction now and you're shifting that income to your later years when you're supposedly in a lower tax bracket. Converting income to capital gains. So now this isn't as important now because the taxes are so low. Dividends and interest used to be taxed differently, but now dividends used to be taxed the same as interest, but now dividends are taxed at the same rate as capital gains. So there's it's better for you to invest your money in stocks and make your money through dividends and capital gains versus interest. Well, you can't make any interest anywhere anyway. All right, and so remember, I think I mentioned this in class last week. If you hold on, what's the difference? Well, let me ask you this. What's the difference between the short-term capital gain and the long-term capital gain? A year, yeah. So if you've held something for less than a year as a stock and you sell it, it's going to be taxed at your regular tax rate, which is significant. If you hold it for longer than a year, it's taxed at the long-term capital gains rate, which is 0 up to $40,000 if you're single, and up to $80,000 if you're married. And then after that, I think it was 15%. So the long-term capital gains tax rates are quite low now. The Biden administration is talking about increasing the capital gains rate, but only on people with more than $1 million in capital gains. So it shouldn't affect too many of us or any of us. Okay. Okay, that's all I wanted to mention about chapter 3. Any questions on taxes?
All right, let me pull up chapter 4 then. Okay, so chapter 4 is on cash, managing cash and savings. All right, so. All right, so we all have to have, money in the checking account, money in the savings account. What's one of the issues what's one of the biggest issues we're facing today regarding savings? Inflation. Yes, inflation is an issue because inflation has really been less than 2% for a long time. And last week the Fed said they want that we can expect inflation to be a little bit higher than 2% for a while and they're okay with that because they want the long run average inflation rate to stay around 2%. So we are facing higher inflation, even though it's not a big issue. It is higher than it has been in the past. And what's historically low right now? Right, interest rates. So for years, really since 2008, really for the past, 13, 14 years, we've had this situation where you can't make any money putting your money in CDs. And CDs are these, you can buy a 5-year CD and maybe make 1%. You can't even keep up with inflation. So that's one reason why the stock market has done so well since our last recession, because you can't make any money anywhere else. So there's really no incentive to put your money in CDs or in any type of savings vehicle. People just decide, well, we're just going to take the risk and put it in the market. And then that's another reason why every time we have these little downturns in the market, it never seems to become a correction because there's so much money out there on the sidelines. Every time the market goes down, people put the savings in, they put more money in. And so that happened last Monday, if you recall. There's this, I think it's called Everguard. Everguard's the name of Everguard is this Chinese, this huge Chinese real estate developer. They missed one of their loan payments, a bond interest payment, and the market in Hong Kong went way down. The markets were way down here last Monday. That was one of the reasons. And anyway, that a lot of people thought, well, maybe that's the beginning of a correction with this. Maybe that's the catalyst for a correction. But by Tuesday, everything was back up again, and the market is now higher than ever. So it's like for about, and I've been watching this for the past several months. We'll have a downturn. It might last 1 or 2 days, maybe 3 or 4 at the most, and then the market recovers higher than it was before. Well, part of I think one of the main reasons for that, and I've read articles on this too, that they agree with this philosophy or this theory. One of the main reasons why we haven't had a significant correction, and by a correction in the market, I'm talking about a 10% downturn, is because you can't put your cash anywhere. You can't make any money anywhere. So people are just in the market. All right. So anyway, so we'll be talking about about the difference between banks and savings and loans and credit unions in this chapter, and where we can put our money. So cash management is really just, we're talking about cash, short-term cash. Where do we want to put our cash that we need for the next year to pay our bills and so forth? All right, so here's an example of what we're looking at for our short-term cash investments. This is as of fall of 19. If you had money in a savings account, you're not going to make anything. If you have money in a checking account, this is high.
because I was at the Hancock Whitney a few years ago. And I said, well, what if I have this, like a high minimum balance in my checking account? What's the most you can give me? And they said 0.1%, 0.1%. It's like, there's no point in even doing that. So checking account just basically stays zero. You're not going to make any interest on a checking account. Now, if you have a money market account is like a savings account. It's not guaranteed though. I mean, if you have money in a checking account, a cash savings account or checking account, of course your money is guaranteed. If you put it in a money market account, that is an account. It's like a savings account, but they're investing your money in treasury bills, basically short-term treasury bills, short-term debt instruments. So these could go up and down. The rate that you're getting can go up and down. It can actually be negative on occasion. But over the long run, the reason people might put money in a money market account instead of just a cash savings account is because you can make, over the long run, you can make a little bit of interest, but not a whole lot. We're talking about, where are we? It's still maybe, it's still going to be less than 1%. Now, you can look up, you can Google CD rates. CDs are certificates of deposits. So the way a CD works is you have these certificates of deposits you can buy them for 6 months increments, 1 year, 2 years, 3 years, 4 years, or 5 years. If you withdraw, if you cash in a CD early, you lose all that interest. And so you want to be sure of the timeline. I mean, at this point, I would not buy a 5-year CD and tie my money up for 5 years because interest rates are edging up. But maybe if I wanted to buy a CD, I might buy a 1 year or 2 year CD. So you can see that CDs are going to pay a little bit more. Of course, you get a 3-month one. So this is higher. This is better than I've seen in years. So if you don't want your money in the stock market, but you want to earn more than just having it in a savings or a checking account, then I would suggest buying CDs. Yes.
The checking account rate is at 0.6, but the savings account rate is a little bit less. Why is that? That doesn't seem to make sense.
Oh, right here, this one.
No, the checking account and the savings account / money market.
Oh, yeah, it shouldn't be. I mean, typically the savings account or the money market would be higher. So this is, yeah, you're right. This is not, I don't think this is realistic. Normally this would be lower than this. It just must have been the data that they looked at. So now we actually, a lot of times if I'm thinking about buying a CD or just looking at the rates, you can Google it. You can Google CD rates. Bankrate.com is a good website, and they'll tell you what the CD rates are. And there's some online banks that will offer higher rates if you want to go that route. There's some reputable online banks these days. But we have a local bank, in New Orleans, that historically has pretty good CD rates, and that's Metairie Bank. So I found Metairie, I don't know if they have a Metairie Bank out. Do they have one in Houma? I don't know. I haven't seen one in Houma, but there's several. They have some on the North Shore. There's several in Metairie. There's several in New Orleans. But you can, but if you're really interested in CDs and you want to deposit it, have from a brick and mortar bank, then Metairie Bank is a good one. Do any of you have online banking? Do any of you use online banking? Yes. What's your experience with online banking?
Pretty good.
Who is it, if you don't mind my asking? No, I mean like an online bank. I don't mean using online banking. I mean using a bank that's just online, that doesn't have a brick and mortar store. Okay, tell us about that, Wendy.
I honestly use my savings account more than that one. But I mean, it was when I used to use my main account, direct deposited, checks to deposit. Their rate used to be a lot better.
Do they? So, yeah, Ally Bank, there's this other one, is SoFi. I keep seeing these ads for SoFi. I think they are bank too, an online bank. But
Yeah,
Ally,
they're kind of, they are a bank, but they do a lot of different things too.
they're credit cards too, aren't they? Yeah. So, I mean, I personally have never done online banking, but I know that, had an online bank. You just have to be careful. I would use a reputable one that's been around a while, like Ally, because you don't want to be taken. There's so many scams out there. And just don't access your banking information on a public website. That's another reason I think it might make sense to have a hotspot. If you have a hotspot on your phone, then you can use your personal email hotspot, your personal Wi-Fi hotspot to access this information when you're not at your house. But do they reimburse ATM fees at Ally?
Yes.
Yeah.
There's no fee for checks or.
Yeah.
I even think they waive, I've never overdrawn, but I think they waive a certain amount.
Overdraft? So these banks, you might ask yourself, why do some banks charge these really high fees and really don't pay us any interest, and then other banks are charging really low fees and pay interest? Well, basically it all comes down to how badly do they want money to loan out to people. And so some of these banks, they really want money to enable them to write loans and charge interest on loans. So you can also find really good deals at local banks, like Capital One, for example. They've had some really good deals with interest rates because they want money to loan out. So I would just suggest doing your homework if you're looking for a bank. A lot of people say, well, I like to have a local bank so I can go cash a check or use the ATM, what have you. And it is nice to have a local bank, but you can have both. You can have a local bank and then have an online bank or a non-local bank. I have an account with Hancock Whitney, which I'm not recommending them or anything. My husband had an account with Whitney forever, and we just ended up we have a joint account there now. But he's banked with them for years. They don't have any great deals, but it's nice if you ever need a local bank. You need something done, you can go in there and have a relationship with somebody locally. And then I have an account at Navy Federal Credit Union, which I'll get to credit unions later. It's not local, of course, but the good thing about online banks or credit unions or something, a lot of these institutions, when you use their ATM, they'll refund you the fees anyway. So it's kind of nice to have that option. Someone who's just going to charge you lower fees. Okay, so you might want to explore doing both, a local bank and an online bank or credit union, what have you. All right, so, okay, here they're getting into the low rates. So here, 2007, Treasury notes, we're paying, these are bonds, notes are bonds, US government bonds, 4.5%. Down to 2019, they're down to 1.5%. So that's really why we have stock prices have gone up so much, because when interest rates are low, stock prices tend to rise. It's another reason why the housing market has done so well after the whole fiasco, 2007 to 2009. The housing market has done well because interest rates are so low. So how do interest rates affect the housing market? Yeah, when interest rates are lower, it's a lot cheaper. Your mortgage payment's going to be cheaper, so it makes you can buy more. And so when rates are lower, it pushes prices up. It also fuels demand. And so right now we've got a really interesting situation. I mean, if you have any relatives thinking about selling a home, now is probably the best time to sell a home. We've got record low interest rates, so prices are high. And then after COVID, we have, as a result of COVID, we have really a real shortage. There's a real low supply of homes available in the market. And then in our area, if you add another issue, the hurricane actually helps the housing market in a lot of areas, because now people who have lost their homes or have, decided to move or what have you, if you're selling the home in a desirable area, that actually helps the housing market in those areas. But all that's not gonna last forever, because as soon as interest rates start to go up, that's gonna soften the market. So we've got interest rates going up, and then we also have this shortage of this low supply of homes. It's not gonna last either.
But the historically low interest rates over the long run have helped with house purchases, also helped with cars. You can basically get a car for nothing, no interest these days, or very low interest rates. It also, if you think about low interest rates and low inflation, it helps the government, the debt, because they're paying it back with cheaper dollars and so forth. All right. But it discourages, low interest rates discourages savings. So if you look at historically, our savings rate is about 8%. It's been even lower. But this is this is not realistic, because when they think about savings rates, they're talking about people putting money in savings accounts and CDs. In other words, if I had $1,000 and I put it in my savings account, the government is going to look at that as savings. But if I put it in a Robinhood account, it's not part of the money supply, you see, it's not considered savings. So this is a little bit deceiving, because this is trying to say that, because interest rates are so low, people are saving less. And they are in these traditional savings vehicles, but people are investing more in the market, which is not really considered savings. And it does encourage people to take more risk. And so people, more people are in the market, more people are taking more risks and so forth. All right, and of course, the low rates penalize people who just have been saving all their lives in these savings accounts where you're hardly making anything, because again, it's you're not really even keeping up with inflation. All right. Okay, so let's look at the types of financial institutions. There's depository and non-depository. So commercial banks, savings and loans, savings banks and credit unions, those are depository institutions. The money in those institutions is part of our money supply. These non-depository institutions, mutual funds and stock brokerage firms, those aren't included in the money supply. They're not guaranteed either. If we lose money, you can lose all of your money in these brokerage firms or mutual funds. All right, so let's talk about the different types of institutions. The first one is a commercial bank. So with a commercial bank, typically commercial banks charge fees for checks and so forth. If you don't have a minimum balance, they're going to charge a fee for your checking account or your savings account. Well, not your savings, but for your checking account. And the interest rates are usually quite low. We've talked about the internet banks. They will charge lower fees and give you a higher interest rates typically. All right, so so these depository institutions, the first one is banks, typically charge higher fees. You can also use a savings and loan or a savings bank. The savings bank, just don't worry about this. It's mainly they're very similar to savings and loans, but they're mainly in the Northeast. A savings and loan association, those got started primarily to give people mortgages. And so a savings and loan, just think of it as a commercial bank, except they're mainly focused on giving people mortgages. You tend to get a slightly higher interest rate than on a commercial bank. This is what I really want to talk about though. Credit unions are awesome. With a credit union is a nonprofit institution, and you have to belong to some kind of organization to be able to join a credit union. So if you've ever been in the military,
Navy Federal Credit Union, or if you had a relative who was in the military. My dad was in the Navy. That's why I have it. I have it Navy Federal Credit Union. Had it since I was a teenager. Marine Corps Credit Union, the fire, if you've worked for the fire department, or, you know, different government organizations will have credit unions. So some of you, do any of you have credit union accounts? Anybody? Yes, with,
USA, and I have a name of the word now.
okay, oh yeah, I forgot about USAA. So the good thing about USAA, if you've ever been in the military or had a family member who's been in the military, you can bank with USAA, you can get insurance with USAA. And then if you end up not being in the military, but you're already a member of USAA, you can still be a member, but you just pay a little bit higher amount for insurance. So anyway, if you ever have the opportunity to join a credit union, I would highly recommend doing so, because the fees are so much lower. And the reason for that is because it's a common group of people. So that the banks, they feel like they're not taking as much risk as a normal bank would, because they only have you have to be in a specific organization to be a member. And also they're not accountable to shareholders and so forth. So it's just a small nonprofit organization. When you make a deposit, you're actually buying shares. It's like you're a shareholder. All the members are owners, and you're a shareholder. Your deposits are shares. So the reason I like these credit unions is because they're usually they pay a little bit higher interest rate. The fees are lower, and the loan interest rates tend to be lower, and they're just a lot nicer, better to deal with. So definitely keep that on your radar. If you ever have the opportunity to join a credit union, you should do so. Okay, next we have financial institutions that are non-depository. Okay, so that's any brokerage firm that you're with. I mean, Robinhood would be considered a brokerage firm. Robinhood, Acorns, that's the other app. A lot of these, there's more and more of these brokerage houses that are apps. Fidelity, Schwab, E-Trade, Scott Trade's another one. And then there's certain mutual fund companies, for example, Janus, Invesco, Vanguard is a really big one. So in addition to putting your money with these brokerage houses, you can also just invest your money directly with these mutual fund companies. And Vanguard, if you're ever interested in just buying mutual funds, Vanguard is a really good one. They're known for having really low fees. So they have some really good mutual funds, exchange traded funds. Yes.
Vanguard's a cool one too, because they actually share the profits of their company through their mutual funds. Like the profits and fees that they collect from someone purchasing their mutual fund, they give it back to the people.
Oh, I didn't know that. That's really interesting. So, but they have some really good funds. I'm a big fan of Vanguard. So, okay. Other non-depository financial institutions are life insurance and finance companies. So, you know, a lot of life insurance companies, they have a lot of money. They have a lot of money that they're investing because they're taking all of our premium dollars, and they are, and also they, you know, a lot of us people have annuities through them and so forth. And so, and a lot of these life insurance products that they have investment components in them as well. So they're also seen as non-depository financial institutions. Okay, so is your money insured? What is this FDIC insurance? What is this all about? Well, it used to be, well, basically what happened was back at the turn of the last century and in the teens, 20s, 30s, they had these bank runs. They would have these financial panics, and people would worry that they were going to lose all their money. And so what would happen if we all went to the bank today and withdrew our money? We wouldn't be able to get our money because they don't have all of our money. they're loaning our money out. The reserve requirement, I don't know what it is today, but it usually ranges between 8 and 15% or so. So that means what if the banks have a reserve requirement of 10%, that means they only have to keep 10% of the deposits on hand.
And then after the storm, the banks were running out of money because people were going to get, you gotta go buy generators, gas and stuff, so they need cash, but the banks were running out of money. So they took a day or two to get trucks in.
Yeah, for the money. So that's, that's another really, Matthew brings up a really interesting point. Because like, I remember Thursday before the storm, Thursday or Friday, I was driving back from Mississippi and thinking, definitely I had a full tank of gas, but I was also thinking, maybe I should go to the ATM. It almost makes, I mean, you don't want to store cash in your house, but it's a real problem when we have a hurricane and you don't have cash. And because the banks do run out of money. You know what I'm dying to ask somebody though? I'm dying to find a Tesla owner and ask a Tesla owner, how did the hurricane work out for you with your Tesla? Because this was the first big test, the first real test down here with an owner of an electric car and the hurricane.
Test for all the internet digital things. Because I remember there was one of those like walkie-talkie apps that people were downloading to try and communicate in case the power went out, but it needed internet to work.
Oh,
So of course the towers go down, it's not working.
yeah, exactly.
It's like that. People couldn't use cards because you can't use credit cards and power. So
Right. And then who wants to buy it? I mean, I'm not gonna buy a generator to charge my Tesla. So, anyway, we'll stop on this note and we'll pick up on Wednesday about this FDIC insurance. Good day.
A bunch of the parishes were relying on specifically the mobile services
Yeah,
for the emergency after the storm.
uh-huh.
That was called an issue.